Okay, good morning and welcome everybody to the fourth in our series of weekly webinars. I'm Louise Durkan, I'm your chair for today. And as a backdrop of an ever-evolving situation, we continue our series of weekly webinars today by discussing corporate managed exits and why we consider it to be a relevant strategy for some shareholders to be thinking about in the current environment. There's a Q&A function that is open on the webinar, so please do feel free to submit your own questions in real time. A few of you will have already submitted questions to us beforehand, so we'll do our best to try and answer these at the end of the session. I suppose before I kick off properly, I'd just like to ask you for your patience and to hopefully we won't. But if we do experience any difficulties through the next hour or so, please just bear with us as we try and sort that out for you. Introduce you my on mandates for small and medium-sized enterprises. Has over 20 years of experience of undertaking financial and operational restructuring, mandates for lenders, distressed and special situation funds, SMEs and FTSE 100s. Frank also has extensive experience of leading corporate simplification team in the Northwest. In this webinar, Frank is going to share with us his experience and specialist insights and discuss the key tasks and critical factors and success requirements for the implementation of a managed exit, providing information on how our firm can support you and your clients through this process. So,
Thank you, Louise. Thank you, Louise, for the introduction. As Louise summarized, over the course of this webinar, I'll be taking you through the managed exit process, what it is, why we believe it to be relevant today, and how we do it. Our managed exit offering is typically used by corporate clients that are looking to exit a non-performing or non-core business through a solvent liquidation process. Winding down an operating business can be a daunting proposition, and in our view requires situational experience to ensure it is carried out in an efficient and timely manner, whilst minimizing costs. Typically, many SMEs will not have the experience or resource bandwidth to efficiently wind down a business whilst continuing to run the core business. Next slide, please. So why now? The COVID-19 pandemic initially saw businesses draw on a raft of government support measures to mitigate some of the adverse impact of the pandemic. As businesses have adjusted to lockdown, we are now hearing that many are starting to turn their attention to what their operations may look like post-COVID-19. Some are leaning towards focusing on core business and shedding non-core operations. We're hearing a consistent theme for this shift in emphasis. If I can highlight a couple. Many business owners clearly anticipate that it will be a difficult operating environment as we start to come out of the COVID lockdown. Coupled with the realization that access to working capital to fund the expected ramp up in demand may prove challenging as a result of impaired balance sheets, which have been leveraged up in many cases to cope with the initial impact of the pandemic, with a resulting reduction in debt capacity. Next slide, please. There are additional reasons why a managed exit process might be considered at this point in time. Based on some of the discussions we're having with business owners, it is clear that some have a lack of appetite to resurrect marginal, non-core or unprofitable businesses post-COVID-19. The M&A route may not be optimal for shareholders, given that we expect it to be a buyer's market with a resulting dampening impact or effect on equity valuations. Finally, where the target company is an underperforming business, some owners might prefer to take it through a solvent process rather than have to deal with the stigma of an insolvency. Next slide, please. So what are the key prerequisites when it comes to undertaking a managed exit process? Following a decision to wind down an operating business, there are 4 key objectives that must be met before the formal process of returning capital to shareholders can take place. The company has to achieve commercial dormancy, operational dormancy, tax dormancy, and finally, legal dormancy. Next slide, please. This slide sets out the key work streams that are essential for the successful implementation of a managed exit process. I'll take them in turn. Operational wind down. If we use the example of a manufacturing business, some of the key tasks with this work stream might include decommissioning plant and machinery, ensuring that processes are put in place for the adherence of on-site health and safety regulations, and ensuring that a plan is put together to deal with environmental matters and ensuring the cleanup of any hazardous materials on site. The commercial workstream would include matters such as identifying and terminating all commercial and supplier agreements, settling any associated termination costs. A key consideration in this regard might be trying to understand the monetary trade-off between paying the early termination costs to exit supplier or contract agreements versus allowing certain contracts to run off over a period of time. With the stakeholder management workstream, a key deliverable will be the preparation of a communication management plan for stakeholders such as lenders, customers, suppliers, employees, landlords, local authorities, etc. You might also include a PR strategy depending on the profile of the target company or its shareholders. The asset realization workstream really does what it says on the tin. The key focus here will be maximizing the realization of assets, and to undertake this task, this would usually necessitate the instruction of independent valuation agents to help you value any tangible and intangible assets and support with the disposal process. This workstream would also necessitate interaction with the company's customers to ensure that all outstanding debtor monies on the ledger are collected. The property workstream would tend to comprise of landlord negotiations, the preparation of a lease exit strategy focused on minimizing lease break costs. Where the company also operates from freehold properties, thought would need to be given to ensuring security arrangements and adequate insurance cover in a vacant property scenario, especially as operations start to wind down and employees start to be made redundant on a phased basis. The final workstream deals with the return of capital to shareholders. This occurs via a solvent liquidation process. As the company has to be solvent, one of the key tasks with this workstream will involve around ensuring that adequate tax advice is taken to ensure that any structuring matters are done in a tax efficient manner. Other tasks may include arranging for the elimination of any intercompany liabilities where the target company is part of a group, or arranging for a capital reduction exercise where there's negative reserves on the balance sheets that need to be eliminated. Next slide, please. So what is our approach and what does good look like from a Quantuma perspective? We've sought to use a simple process map on this slide to outline or indeed explain our broad methodology. The first stage of our process would be the strategy validation phase. In this phase, we sit with management and the board to ensure that a proper and thorough review and validation of the reason to undertake a managed exit process has been undertaken. We will usually support the board with documenting the decision process to ensure that they continue to abide with their fiduciary duties. The planning phase will encompass a preparation of a detailed plan with an associated implementation timetable, designated tasks to key workstream owners, all enshrined within a project management tool. It is at this stage that we will ultimately estimate the total cost of the managed exit. At the implementation stage, the extent of our involvement will depend on the resource capacity of the client and their functional competence. Our range of support can extend from providing management with a plan and allowing them to proceed to implement it themselves, only intervening if called upon, to a full hands-on support where we effectively own and implement for managed exit. The key message here is that we can be flexible and right-size our support according to the client's particular circumstance. The formal closure phase is the solvent liquidation or member voluntary liquidation process, which I discussed in the earlier slide. And ultimately, at the end of a well-planned and well-thought-out and implemented managed exit process, shareholders should see a significant return of capital. Next slide, please. To finish, we thought it'd be useful to bring to life the concepts I've discussed with a real-life example of a managed exit project. Project Mountie was an engagement in which I supported the corporate shareholder of a small London-based investment bank with a controlled solvent wind down of the bank's operations. The client was keen to avoid an insolvency for PR and other reasons. To give you some context, some key facts about the target operating business was it was an investment bank with a trading desk specializing in options, swaps, and futures. At the date of engagement, it had approximately £18 million of unreconciled client account monies. It had open trades of approximately £50 million, which needed to be closed out. It had approximately 30 employees, including derivative traders. And an added complication with this project was the extensive and sophisticated stakeholder base, which ranged from the FCA to investment banks, institutional investors, and other sophisticated counterparties, as well as trade suppliers. So what was the outcome? Over a 5 to 6 month period in which we worked hand in hand with the management and employees, we managed to successfully wind down the bank's operations. We closed out open trades, working with the support of the derivative traders. This yielded a significant recovery of net cash proceeds from closed out derivatives of circa £40 million. In addition, we completed the complex exercise of reconciling the client account and returning the entire £18 million to third parties, whilst abiding with the FCA's cash rules. Ultimately, this engagement yielded a significant return of capital to shareholders after the payment in full of all of the bank's creditors and employees. To conclude, we expect to see more business owners and shareholders consider using a managed exit process to future-proof their business, streamline their operations, and focus on their as part of a strategy of focusing on core business. My parting advice would be, if our business owner or corporate shareholders are considering embarking on a managed exit process, there's no substitute for seeking professional advice from experienced advisors with real-life situational experience of having planned and supported the implementation of a managed exit process. You don't know what you don't know. It's a phrase I often use when having discussions around this area. Thank you very much.
Thank you, Frank. That's a really useful and insightful look into the process of managed exits, and a particularly interesting case study that you've walked us through. I suppose we do have the option available for those that are listening in to add on to our Q&A function to ask any questions coming out of what you've just listened to and what Frank's been talking us through. We have got some questions that have been submitted previously, so while I'll allow our participants to use the Q&A function, I'll just pick up on some of the questions that we've already had in advance of today. And one of the questions, I guess, Frank, that's come through that's a fairly common question is, obviously there's a range of issues facing businesses at the moment, but what opportunities does the current economic climate and landscape bring to these kinds of transactions?
Yeah, thank you, Louise. It's a great question. In my day-to-day, I think not myself but others around the firm are seeing some inquiries from clients where they're adopting quite an interesting approach to the current situation. These would be businesses where perhaps they've been only marginally impacted by the pandemic, but nonetheless, they're using this hiatus period as an opportunity really to get professional support to do a drains up review of their existing business and operations. Because often or not, the refrain from these clients would tend to be, there'd be several, operational issues and improvements which they've always considered doing, but have always kicked the can down the road, as it were. But this hiatus period has now given them an opportunity to actually look to address some of those issues, to really right-size their business, and I guess future-proof it to be able to take advantage of any opportunities that may arise as we come out of COVID. So I guess in conclusion, I mean, some clients are taking the view that this is the time really to take a look at those businesses and see how they can streamline it and really put it on a proper footing to either grow as the COVID passes, hopefully, or take advantage of any opportunities.
Okay, yeah, that's pretty clear in terms of the businesses that we're seeing and we're speaking to. I guess one of the other challenges currently, and then this will be common across many businesses, that clearly as a consequence of where they find themselves, irrespective of the business, there may well be a number of individuals and employees, management alike, that may have been furloughed amongst the business. So I guess the other aspect of this that would be interesting to get your take on is, how do businesses in the current context of maybe having limited resource within the business, within the management teams, actually go about preparing themselves for this kind of project? How do they accommodate that with maybe limited resource within the finance function or within certain operational functions?
Yeah, absolutely. Again, another great question, and it's entirely pertinent. I guess, over the course of having undertaken a few of these type of engagements, I'll be introduced to certain scenarios where businesses have actually tried to do this themselves. And not in all cases, but in many cases, you often hear about, they sought to undertake what can be quite a daunting process, usually by asking a designated team within the functions, within the finance function usually, to almost treat it as a side project in addition to their normal day-to-day jobs. With the resulting effect being that actually the project either completely run over time or become far too costly to implement. So I guess, Louise, to answer the question directly, I will always say, and not me trying to create work for myself as an advisor in this space, but I'll always say there isn't any substitute for just seeking some advice, okay, from professionals that have done this before. And the key is, like I said earlier during the presentation, it's about right-sizing the level of support according to the particular circumstance and resource capacity of the client. Some clients will have far more bandwidth to be able to to actually implement a wind down themselves, as long as you give them a plan, whilst others will need a bit more support. And you also have the other end of the spectrum where some clients have absolutely no bandwidth at all. They rather focus scarce resource on business as usual, and in effect allow a Quantuma or other advisors in this space to basically help them implement the wind down process itself. So it really does depend on the particular circumstance of the client. And what I will always say is just have the initial conversation with some advisors who, if they're doing their job properly, should help them right size the level of support which suits their business.
Okay, that's very good advice. And I guess within that, there's potentially other advisors to the business as well that are going to be fairly important as part of the planning exercise. How do you see that sort of fitting into the overall project plan?
Absolutely. I mean, I would actually say it's indeed a key tenet of any proper managed exit wind down plan. You know, an operating business can be all encompassing in terms of when it's being created and built, and similar when it's being wound down in an orderly manner. That process is also all consuming and will require input from not just one or two entities, but indeed several. I already talked about the 4 key objectives before a business can be wound down solvently, which is commercial, operational, tax, and legal dormancy. I mean, some of those headlines, make it clear that to undertake such a project, you will need, subject matter experts in terms of the actual doing, but you also need expert advice from agents, from tax structuring experts, from lawyers. You will have a whole raft of agreements, supply agreements and contracts that will need to be reviewed to ensure that there aren't any contingency or latent liabilities which may come out of the woodwork. Tax structuring is an absolutely integral part of any managed exit and solvent liquidation process. And indeed, under UK legislation, before any capital can be returned to shareholders in a solvent liquidation, the entity would need tax clearance from HMRC. So absolutely, Louise, you can't do this in a vacuum. You will need a lot of professionals and advisors to ensure this is done properly in a riskless manner.
Okay. And is there, and I suspect the answer to this question is no, is there any kind of average time frame that it takes, between the sort of various different stages when ultimately, what certain stakeholders are looking at is ultimately the return of capital back to them. They're looking to get their cash out of this business. Is there any kind of time frame that you can wrap around this that gives a general feel of typically how long these projects can take?
I mean, it was a leading question, Louise.
It was.
And you're absolutely right. I mean, it depends, okay? And that isn't a cop out. I think that's just simply the reality. I mean, businesses will have different motivations and have different sets of circumstances. Their shareholders and stakeholders, again, will have divergent expectations and objectives. If I can break it down, I guess, into bits, if you like. So the managed exit process, again, really depends on the sector the company operates in, the complexity of its operations, and as a consequence, that would then dictate how long it takes to actually wind down those operations. Are they subject to many many legal agreements, which some may be exited quickly at a cost, and some may require a longer run-off period. So if you like, the pre-solvent liquidation stage, the actual managed exit process itself, the time will vary according to the particular circumstance and type of business that we're dealing with. In terms of actually returning capital to shareholders, so solvent liquidation will typically last 12 months. I've seen examples where that process has been completed in a shorter time frame. And within that process, again, you will have a scenario where certain shareholders maybe they're institutionally invested or perhaps PE, where for maybe tax planning reasons or other reasons, may want that return of capital to occur earlier than 12 months. Again, there is, subject to making sure that the actual office holder has a line of sight as to any potential contingent liabilities which may come out of the woodwork. There is an option where an element, let's say 50% perhaps, or maybe even a higher percentage, may be returned to shareholders within, say, a month or two of the commencement of the solvent liquidation, with a buffer held back until tax clearance and all latent liabilities have been dealt with. So again, it really does depend on the target business, the particular circumstance, and also as well the motivation and the makeup of the shareholder population.
Okay, that's really helpful, and it was a bit of a leading question, so I do apologise. I suppose the other aspect of this, we've talked a little bit about where you are effectively winding down and closing and exiting literally from a business or a non-core element of your division. But is there other ways of exiting out? So we've talked about managing the exit, but what about selling the business? How do we feel about that kind of approach within this project planning?
Yeah, absolutely. And again, and I think it's another good question, because a managed exit process, I think the ultimate aim is winding down operation. Okay, and there might be a hybrid of a project where actually, again, if we're dealing with a non-cooperation that has multiple businesses and multiple divisions, I've been party to previous engagements where, some of those businesses are wound down, and actually some, again, depending on the particular circumstance and dynamics of their market, can be disposed. So again, a managed exit process, will involve corporate finance professionals, for example, because okay, there's no cookie cutter approach to this. It really does depend on the business and the outlook of the business. So yes, an engagement might involve a simple straight wind down of operations and solvent liquidation of a business, but also allied to that would be there might be certain divisions or sub businesses which can be sold by way of a formal M&A process.
Okay, and so typically where that kind of alternative, so it's not a wind down, but it's maybe an exit by way of a disposal. Again, I guess there's a variety of component parts coming out of that. But do we typically see that kind of structure of a transaction as being a simple vanilla corporate finance engagement, or are there potential other ways that transaction might occur?
Again, I guess it always comes back to what is the driving motivation of the shareholders. Okay, so I've seen scenarios where, for whatever reason, perhaps you have the rare occurrence where, for a particular business, is the net assets on its balance sheet might yield more value than actually going through a formal M&A sale process. So depending on what the motivation for the shareholders are, will really dictate whether they're happy allowing a sub-strategy, if you like, of going down an M&A route for part of the operations, as opposed to simply winding down the entire operations and getting value back by way of the disposal of net assets. So again, it really does depend, because none of this is ever black and white. It really does depend on the motivation and the outlook of the shareholder.
Yeah. We've had a question which I think is probably specifically to what exactly we're talking about, and what do we see as a bank's attitude to solvent liquidations where a non-core subsidiary is being exited? What are the issues and concerns around from the lender's perspective as one of the stakeholders?
Absolutely right, absolutely, and particularly every business will have a financial stakeholder. We usually have a lender. And I would always advise, as I referenced in having a communication plan, I would always advise, certainly as one of the primary stakeholders in any business, early consultation with lender or lenders is key in all this. From a lender's perspective, it's always about, their concerns are usually centered around the extent of the security, and will any process lead to an impairment of their exposure. Ultimately, that's what most banks will be concerned about in this scenario. So providing that the bank, a couple of things, provided the bank is comfortable that there's adequate security to ensure that it gets that in full. Or perhaps the bank may, if in a group scenario, the bank may have lending not just to one company, but actually to the entirety of the group. If that is the case, providing the bank is comfortable that the subsidiary or the non-core business being disposed doesn't impact on its overall security, they might take a fairly benign view of it. But what I would say is, if the client believe that there is a risk that the bank may suffer some impairment to its exposure or dilution in security, for whatever reason, by winding down its operations, then they should be consulting the bank at an early stage. I mean, naturally, given that the denouement of a managed exit process is a solvent liquidation, the whole idea of a solvent liquidation is that all creditors get paid in full. I think it'll be a rare occurrence for a managed exit process to lead to a bank suffering any kind of impairment. So given the case, I would imagine most lenders would take a fairly benign view of this. But the key is as long as the security isn't impaired on a wider basis.
Yeah, and I guess part of the initial planning and assessment piece would identify the extent of security, the assets that there's coverage against, and if as you say, in a larger group scenario, particularly if there are sort of cross guarantee positions and those need to be addressed and tidied up effectively as a consequence of the transaction, then again, that is something that needs to be dealt with. But yes, we're assuming here that this is being done in such a way that there isn't an impairment consequence to any of these pieces of work that are being undertaken. So
that's right, Louise. And
that's the assumption.
Absolutely right. And just an additional point, just to overlay on that. I mean, typically, all banking docs will have clauses actually that govern the extent to which the borrower can actually dispose of shares or dispose of operations. So again, the lawyers come in here just making sure that, again, legal advice is taken, but ensure that actually, under the terms of the lending agreement, the company can actually undertake a managed exit process and just make sure that any requisite sign-off from the bank is obtained in advance.
Great, very good advice. Okay. Well, I think that's covered off the questions that we have. So unless there's any more coming up on the Q&A, I think we've carefully navigated our way around the various questions that have been raised. So thank you, Frank, for that. And I suppose I would just say in closing that these kinds of projects that are often entered into in different times to these are equally as relevant to a number of businesses at this moment in time. There are businesses that are looking, as Frank said, to right size, looking at their operations overall, looking maybe to what is more non-core or potentially elements of their businesses, I suppose, that in the short to medium term they see as not fitting quite as well into the model moving forward. So there is a range of opportunities and instances within businesses at the moment to look at this kind of planning and undertake these kinds of projects. So as Frank says, to have your advisors on board that are familiar with these situations will be pretty critical to the success and the delivery of those plans. So thank you very much, Frank, for your time, and thank you very much to everybody that's joined us and dialed in this morning. We do hope you found the webinar useful. Please do join us again next Friday at the same time. Our webinar for next Friday will be, as it's come up on the screen, we'll be looking at the challenges within the legal sector, and we will be joined next week by partners in our insolvency and restructuring team, together with guest speakers from Pinson Mason. The full details, as you can see, will be available on our website, and you will be able to register via the website. If there are any questions coming out from today's session that we didn't manage to answer for you, then please, we can follow up directly if helpful, and there are contact information on our website for that. And lastly, I'd just like to say once again, thank you very much to Frank for taking time out of his day today to share his knowledge and his experience with us. Thank you everybody who's joined us, and hopefully not experienced too many technical hitches other than a little bit of sound quality, I believe, at the beginning. But thank you all very much for joining us, and have a very good weekend, long bank holiday weekend, and everybody please do stay safe over the course of that weekend. Thank you.